Yep. So the qualified mortgage, pretty much you can't go over your points and fees. So that's going to be loan origination fees. Not a lot of people charge loan origination fees, but some do. So, we just need to be careful to stay under the threshold of 3%, or else you're not going to have a qualified mortgage. Your loan terms must be 30 years or less. So you can't do a 40-year amortized loan.
Right.
Balloon payments, they don't want to see balloon payment terms. What I suggest in lieu of a balloon is to do an adjustable rate mortgage. So do an ARM. You do have to have it fixed for 5 years. That's one of the rules. But after 5 years, if you do like a 5-year ARM, then you can aggressively increase that interest rate. So it helps them kind of get encouraged to refinance or pay off the loan. That's another avenue. Instead of doing a balloon, you can do an ARM.
That's a good idea.
And then the no negative amortization really is just if you're going to try to do like an interest only type of loan, you're putting that buyer kind of in a bad position at the end of the term. You don't want them to be upside down on their loan. And so no risky features on these loans that you're writing, or these notes that you're writing.
Okay.
And the APOR, average prime offer rate. So we also, just let you know, whenever we get your transaction and we're going to originate your transaction, we check what that week's APOR is, what the prime rate is, and we calculate that for you. And we say, okay, whether you're good or maybe you're just a little bit over that threshold. So we just make sure that you're under it in order for you to have a qualified mortgage. So that would be prime rate plus 6.5%.
Yeah.
So if today's prime rate is 7.25, then you're going to add the 6.5% to that, and that's your max interest rate that you can charge that end buyer.
See, and I always thought that was a
state-specific
thing, but that's a national qualification.
This is national, right, national. So the state-specific interest rate thresholds, those are when you're getting into like the 20%, interest rates. When you're going way above these thresholds here. So it's not, I don't think that you can really compare the same thing, because we, as professionals or originators, we're not going to let you get to that usury rate.
Right. Okay. Interesting.
So what's this high price versus high cost?
So that being said, the higher price versus the high cost, this is where today, if you go 6.5 plus prime, you're going to be considered a higher priced mortgage. If you say, Sarah, you know what, I don't care that I'm over that. I don't care that I have a qualified mortgage. I still want to write this note. I want to go as a non-QM. Okay, we can still do that. But now you're going over onto the high cost mortgage. So if you go over that interest rate threshold of 6.5 plus prime, then you're going to be considered a high cost mortgage, and you can still do it and you're still okay. You're not breaking any laws. There's just other small items that you need to do. The buyer has to take like a home buyer's class, a first time home buyer's class with a certificate and everything. You have to get 2 appraisals on the property, extra disclosures, things like that. So you can still do it. You just have to have your buyer go through a little bit more of a
just to clarify,
qualification process.
Okay. What if this is a land contract? I know Texas doesn't do land contracts, but from our understanding, it doesn't matter what the type of instrument is for the connection. It's the fact that the note itself, it doesn't mortgage, land contracts, CFDs, all come in the same bucket, that if you're creating a note backed by some kind of security instrument, this needs to be in place, correct?
Correct, because it's all about the origination of that mortgage note.
Yeah.
So if you can just think about that, it's the origination piece of it.
What about a lease with an option to purchase sometime in the future? Is that the loophole?
So yeah, I think every state has their own laws on that. Texas has 6 months. So you can only do a lease to own for 6 months. After that, you have to transfer the deed. So, or you have to actually do the actual closing with them. So for people that are listening that are in Texas and don't know that, that's a big one. You need to make sure that if you're doing lease to own, that you're actually selling the property to them month 6.
Okay. Very good. Interesting.
So we already talked about the foreclosure court a little bit. If you do have to foreclose on a property and you go to foreclosure court and you don't have an RMLO involved, or your package or your underwriting or ability to repay or anything that says that, hey, I did what I was supposed to do to originate this loan, then you're going to be required. They're still going to give you the foreclosure, but you're going to have to pay back any interest that you've earned on that loan and any closing costs, attorney costs, court costs from the time of origination.
That's really stiff.
This is getting scary, guys. For those who are
Yeah.
originating loans and watching us, and
Yeah.
you didn't do any of this stuff, this is your business. This is your livelihood. This is food on your table kind of
Yeah,
stuff.
it's just not worth it.
Yeah.
Yeah.
So
So yeah, just getting a little bit, more serious there with the fees and fines, the fines and fees.
and we'll go into that
But
deeper. We'll do it deeper with our attorney. We're gonna have Jeff Watson come on next, our next webinar on the 26th for those who are tuning in, and that will be just before DME. So we're gonna take a break to DME week because hopefully we'll see everyone there, and focus on the fines before we get there. So those who are curious about it, make sure you learn about joining the 26th for that session. Talk about it.
Yeah. Get your legal questions together for that one.
Yep.
We'll pepper Jeff with that.
Yeah, actually, absolutely.
Okay, so this is a big one for note buyers. I get this all the time. I get note buyers calling me saying, "Hey, I got portfolio here. It wasn't originated correctly. What can we do?"
Yeah.
So the easy answer is re-originate it. So the way to do that is to do a loan modification on each one of them, or to do a loan modification on that loan. The only thing that you're required to do is give them a better term. So I would suggest, let's just say that note is 5 years, 5 years old. Maybe you rewrite that loan as a 25-year mortgage note, reduce the interest rate just a slight bit, and then there you go.
Yeah. So if you create a land contract or CFD, if you're outside Texas, of course, and you are originating this incorrectly, just go back to the borrower and say, listen, we're going to flip this over to a mortgage, right? We'll create a note, we'll create a mortgage, and we'll get rid of the land contract. If you're in Texas, you create this, make a deal with the borrower and say, listen, we're going to make a deal. We're going to fix some stuff up. Things have changed a little bit, and we're going to drop your 0.5%. Let's recreate this thing and get you in a better spot. And that's how really to fix it should be done.
Sign that, and then you're good to go.
Yeah. And then we get buying it. We'll start buying it. So
yeah,
we're almost done. We'll get to some of the stupid questions as well.
Sure. Yeah, so the underwriting package, just so you know, it just includes a statement of compliance, and it's just going to be, really just the loan officer saying, hey, we've reviewed, we've verified, we feel like this buyer does have the ability to repay. You're good to go. You got a good loan. The qualified mortgage report is something that our loan system spits out. It's just going to say check mark, check mark, check mark. Yes, you have a qualified mortgage. Mm-hmm. We do provide you with a credit report. Again, we don't review it. We don't look at it. We don't put it up as a part of our qualification process. The only time that we'll come back to you is if there's a red flag, foreclosure, any kind of federal laws, bankruptcies, major things like that. Then we'll say, hey, red flag. You need to review this before we proceed or move forward. And then, of course, the proof of income, whatever the buyer has provided, all the supporting documents for the ability to repay. And then the main thing is the loan disclosures. So if we want to flip to the next one, we can kind of go to what we're going to be providing them. The number one thing is the loan estimate, right? Because again, Dodd-Frank wants you to be super clear and transparent with your buyer. That shows what the loan terms are in black and white, in writing, and that they've acknowledged it, right? So later on, they can say, why do you know my interest rate was 9.5%? So here we're just going to show really quick, just the highlighted areas that we're showing them where the loan term is, what type of product it is. One of the big things on here is going to be the monthly payment. And that there's no balloon penalties, prepayment penalties. Oh, we didn't even go over that one. So prepayment penalties is a big one too. So a lot of investors think that they're allowed to charge their end buyer a prepayment penalty, but because they're used to being charged a prepayment penalty, a lot of hard money out there, you have prepayment penalties. So they say, well, well, my loan has a prepayment penalty. I need to pass that on to the end buyer. But you can't, because again, you're not a protected class. They're a protected class.
Yes.
Got it.
So they can pay off their loan whenever they want, and you can't stop them from doing that.
That's amazing.
And you shouldn't, quite frankly, and this was a discussion on Facebook here this week. I saw, no, of course we want to get paid off early. Are you kidding me?
Yes.
that shoots our returns through the roof. So
Yeah, we
encourage
had
all my buyers.
we had a whole thing
refinance.
about like, how do you determine your return, right? And the faster I get my money back,
Yeah,
the better it is. However, you don't get the interest for that time period. But if I collected interest for 3, 4, 5 years, and then I get my money back, I reinvest it. So I'm going to get a
Absolutely.
quick return and be boom. And if I bought it at a discount, I'm going to get, for those note buyers, right? If you bought it at a discount, you're going to get the entire UPB and be singing to the bank the whole way there. So absolutely.
it's almost always, that's one of your best exits. So
Yes.
yes, you want them to repay quickly.
Yeah, refinance out, whatever you,
Absolutely.
however they do it, it is golden when they get
Yeah.
out. So
Yeah.
So again, we talked about this. You have to disclose your total payment, break it down, what's principal and interest, and what's your taxes and insurance. You do have to escrow on an owner finance loan within the first 5 years, or at least for 5 years. After 5 years, if they want to remove the escrow, they can pay that on their own. But it's just really, again, you don't want to set your buyer up for failure. So if you were to separate it in the beginning and they don't pay their taxes, you're going to go foreclose on them because they haven't paid their taxes. So that's not a good thing. So it's better to just say, hey, this is what the total monthly payment is going to be, and you need to be able to afford the total monthly payment, right, every month.
Yeah.
So on the loan estimate, we also give them the estimated cash to close so that they know exactly what they're going to be bringing to closing. That's important, so that they're prepared. And they all, the other thing is just to provide proof that they have the funds to close.
Awesome.
And then the next slide will show kind of a breakdown of what the fees. So this is like an old slide here, but we have an estimate of what the closing costs are going to be. We've worked with a ton of title companies and everything, so we kind of know what everything's going to cost. So we just do an estimate of all the fees. The other thing is that we suggest is to always collect 2 months of escrow reserves. Again, this is just our suggestion. It's not something that you have to do. The other thing too that we recommend is for you to have them pay 1 year prepaid home insurance. Reason being is if they don't do that and they don't make their payments to the servicing company for 2 months, that home insurance could lapse, and you might not have insurance on your assets, or your collateral protection, right?
Right.
So you don't want to be in that position where your buyer's not making their payments and the insurance is not getting paid. So that's a big one. So we recommend that you have them pay it 1 year in advance. That way, no matter what, they're always going to be covered within that first year, and so forth and so on forever.